Hello, ladies and gentlemen. This is Mortgage Mario reporting live with your mortgage topic of the day. I hope everyone is having a wonderful week and is staying safe out there. So let's dive right into the nitty gritty and discuss conventional loans. Conventional mortgage loans are found on the Fannie Mae secondary mortgage market. Fannie Mae is not backed by a government agency, but confusingly enough, conventional loans are considered a government sponsored enterprise. Um, Conventional loans come in two different categories: conforming and non-conforming loans. Conventional loans function by being originated and serviced by private financial institutions such as banks, financial institutions, and credit unions. A good rule of thumb is conventional loans have stricter guidelines than governmental loans, such as with higher credit scores and lower debt to income ratio, or DTI for short. Generally, borrowers will need at least a 640 credit score and a debt to income ratio of 40% or below to qualify for a conforming conventional loan. For borrowers with lower credit score, there are other mortgage products with lower credit score requirements, such as FHA loans. And interest rates for conventional loans depend largely on the applicant's credit score and credit history. The higher the credit score, the lower the interest rate, because lenders will categorize borrowers with high credit scores as lower risk versus low credit score borrowers. For this very reason, you need to maintain a healthy credit score so you can secure the best possible interest rate and save some serious money. So the down payment amount for conventional loans can be as low as 3% for the first-time home buyers, but typically though, the minimal down payment for a conventional loan is 5%. Please take note that if you don't put down 20%, then the lender requires you to pay private mortgage insurance, or PMI for short. PMI protects the lender in the event the borrower defaults on their loan before 80% loan to value. When at an LTV above 80%, borrowers also have the option to break down PMI into monthly PMI or upfront PMI. When putting down 20% isn't an option, then paying an upfront PMI potentially could save a borrower a boatload of money when compared to monthly PMI. Take note when deciding between upfront and monthly PMI is largely dependent on how long the home buyer lives in the house. So when you're uncertain about your duration of stay, then you're probably better off going with PMI monthly. Also, the second lien position mortgage product like piggyback financing can be a way to bypass PMI without actually having to put down 20%. Most people secure a 30-year conventional loan, but there are conventional loans with shorter terms, such as 15 or 20-year conventional loans. And so when cash flow isn't as much of a concern, then executing on a 15-year loan can save a borrower thousands of dollars in interest over the life of a loan. Remember, though, this is due to the simple principle that a dollar today is worth more than a dollar tomorrow. As of 2021 in Georgia, the maximum conforming loan amount is $548,250 for a single family home. In even higher cost areas of the country, this limit can be much, much higher. If a borrower needs to access more capital, then loan products such as jumbo conventional loans are a viable option. These loans are big boy loans, okay? Keep in mind, due to the added risk to the lender, jumbo loans require a much higher credit score, typically around 770 and up, versus conforming conventional loans. Jumbo loans also require lower debt to income, or DTI, and usually require a higher down payment amount. With all that said, jumbo loans usually have higher interest rates than conforming loans. And again, the higher the interest rate, the bigger the risk there is for the lender. So portfolio loans are conventional loans that provide more lenient underwriting than conforming loans and are an option for borrowers who have lower credit scores and high DTI. However, portfolio loans don't offer as much protection and come with high interest rates. In many cases, a borrower probably would be better off investigating an FHA or USDA loan if applicable. Subprime conventional loans require a lower credit score and DTI of below 50%. Although they are easier to qualify for, interest rates are much higher than a conforming loan. Amorized conventional loans have a fixed interest rate and payment throughout the loan. At the beginning of an Amorized loan, the borrower pays more interest, but then starts paying more towards principal as the life of the loan increases. Fixed rates make complete sense during times of lower than average interest rates. So if you can lock in a low interest rate, not a bad idea, probably a wise decision. Adjustable conventional loans interest rates fluctuate through the life of the loan, with interest rates being dependent on the current market rates. ARM loans can certainly be a gamble, but if you're only going to be in the house for less than a few years or so, and you think the interest rates will drop, then an ARM loan can be an option to consider. Some advantages and major benefits of conventional loans can be low interest rates, higher loan limits, and more flexibility. Some disadvantages of conventional loans are stricter credit score guidelines when compared to government backed loans, higher down payment amounts versus FHA, which is a down payment requirement of 3.5% when the borrower has at least a 580 credit score. And VA loans and USDA loans don't even require a down payment. So when cash flow is a concern, then conventional loans can be a little bit more tricky and a little bit more challenging to qualify for. To successfully secure a conforming conventional loan, it is essential to maintain a high credit score, low DTI, save for the down payment, and get pre-approved by a mortgage loan officer. It is very wise to get pre-approved before you start the home shopping process. A pre-approval letter also can enhance your chances of a seller accepting your offer. Pre-approvals are typically valid for 90 days. So it was a pleasure having the honor of presenting the mortgage topic of the day. Until next time, this is Mortgage Mario signing out. Stay classy, everyone.